On the program now is Paul Mirren from Msquared Capital. And I want to talk about Evergreen, the Chinese property developer, in a lot of trouble. And what are the implications for the world in the money space that Msquared Capital works in? And also, what's the implication for investing in Australia? Paul, thanks for joining us.
Thank you, Peter.
So just set the scene. You've written an interesting piece on Evergreen. Just to set the scene, what happened with this company and why it's in trouble?
Well, look, there's two main reasons. It's the demand and supply in relation to property in China. That's the first reason. And the second is the overuse of debt. Now, Evergreen has come into the spotlight just recently because it defaulted on two payments. And I think they've defaulted on another bond payment as well, a third one, just recently as well. That's why they've come into the spotlight. But really, if you really look at Evergreen, they've been in the news over the last 10 years of a company on the brink of collapse. So the real question here is, how did a company that has been so indebted in China, that has the same amount of debt that equivalent of debt in China, it's about $400 billion worldwide, it has the same, it's equivalent to the same size of New Zealand's GDP, for example. So it's a substantial amount of debt. It's the most indebted company on the globe. And how will it have impact to Australia and the global market?
Okay.
Those are the questions.
Well, what is the exposure of international lenders, financial institutions to Evergreen? I'm led to believe it's nothing like Lehman Brothers, for example,
Yeah.
and the way the collapse of Lehman could really rock the financial system. Is Evergreen in any way in the same neighbourhood as Lehman Brothers?
It's not in the same neighbourhood because the GFC was caused by derivatives and that debt was sold all over the world in much larger quantities. It's not 100% accurate, but they estimate that there's about $22 billion worth of international bondholders in America, could be Australia, around the world. So it's not a significant amount, but what is significant is the China story. The significance of this is that the property sector, it contributes about 25 to 30% GDP a year of the Chinese economy. China contributes about 30% for the last decade of the world GDP. So the fact that it's not I don't think it's a situation where you're talking about one company in isolation. You really want to be looking at, does the Chinese property market work in the current state? And will it have flow-on effects as well?
Okay. Have you seen forecasts of Chinese GDP as a consequence of a major blowout from Evergreen and other developers like it?
Okay. Look, there have been some economists who've been saying, well, it's going to take 0.5% off GDP in China, or 1%. But it's very difficult to know. If you look at the fundamentals of the Chinese property market, the reason why they've gone to such a level is that you've had, and it's an amazing story, in the last 30 years, China's become a second largest economy in the world. Per capita, they were one of the poorest on this planet. They've taken 1.4 billion people from country areas and they've built mega cities. The amount of construction that's happening at the moment, for example, it's estimated that there's 19 million dwellings being built on a yearly basis. Now, that is more housing that we have in all of Australia, that they are developing on a yearly basis as well. The fact that the other interesting thing as well is that they have an oversupply of property at about 90 million at this present moment. The reason why they have such an oversupply of property is that a lot of Chinese people who have done a very nationalistic thing is they want to be part of this boom, and they're being told or given an option to invest into property. Now, there is 22% of all the housing supply in China is empty, because 68% of all the net wealth the Chinese hold is in these empty properties. Now, these are fundamentals that are completely outside normality, where I think that it's going to take the Chinese government a long time to deflate those prices and come back to some type of normal demand supply.
Yeah.
I think that's the issue.
In a sense, what you're saying is that Evergrande was a great supplier of those ghost cities that we've been hearing about for decades. I think most of us might have thought, oh, well, the government probably produced those and therefore they can basically allocate them as they go along. But there is this private, in inverted commas, private corporations like Evergrande who are very, very exposed to this whole situation. What do you reckon is going to be the implications for the international money market?
Well, look,
effect or manageable effect?
I think a really good a quote from Howard Marks is probably appropriate here, is that investors have to be worried when they see three things in the market. When there's too much money in the market, not enough opportunities, and they complete disregard to risk. So it's just a reminder to investors that these things can happen, and it could create a bit of a credit crunch in relation to the supply of money into different type of sectors. So if I'm an investor, I'm going to say, well, instead of lending money to someone like Evergrande was acceptable, and I was lending at 6% return, I was expecting, and I'm completely unsecured, and it's a highly leveraged company, just on the basis that I think that the Chinese government will bail out the company if it all falls to a heap. Those investors now thinking, well, you know what, there's a lot more risk associated to it. So it only changes a sentiment in relation to investors for a credit crunch or a credit cycle to start changing. So I think there is implications here.
Okay, Msquared operates in the credit market. You guys, taking money from savers who want higher interest rates and are prepared to take the risks of going into funding developments and things like that. Or business loans. Are you worried that there could be an Evergrande effect in the space that you play in?
That's a great question. The reason why I've looked at the Chinese story in so much detail, because out of curiosity, I wanted to understand the fundamentals of difference between the fundamentals of the Chinese property market and the fundamentals of the Australian property market. The reason why the strength of the Australian fundamentals are so strong is that we have an independent RBA that controls interest rates. We have a shortage of supply of property. The other thing that we have from a demographic perspective is that hopefully once we come out of COVID situation, Australia pre-COVID had the second largest immigration per capita in the world. So all of these fundamentals are quite important in relation to having a healthy and strong property market. Another very important aspect as well, where we're seeing with the difference between China and Australia, we don't have empty properties sitting there. We don't have people having no opportunities to invest money and then buying a property just for it to be vacant. Property in Australia is a healthy asset class where it's productive. So you either buy it to live in it and enjoy it, or you buy it for your yield. You don't buy it just to store wealth. Interesting enough, in 2015 or close to 16, when there was the last time we had macroprudential authority come in very strong in relation to investors, the one thing that they did bring in is that if a non-resident was buying an investment property in Australia, they had an additional tax that would be paid if they left it vacant. Okay, so now that becomes a very interesting topic. Why do they do that? Well, they wanted to make sure that the assets that you have in Australia is very productive. They wanted to avoid this whole situation that we have in China right now. So, this is why the sector in Australia is very, very strong.
Okay, so you're comfortable about the Australian sector. Before we go, mate, just one quick one. APRA's decision to make interest loans harder to get by putting a bigger serviceability buffer in there from 2.5% to 3%.
Yep.
What do you think that's going to do to the market in terms of the space that you play in?
Well, look, I think it's a very healthy thing to do, because what they're trying to do is to create. It's unsustainable for the market to continue going the way it is right now. I think earlier in the year we talked about the RBA modeling, and that the RBA modeled that they were expecting property prices to go up 30%. And it's quite funny enough, Sydney's gone 28%, and now we have macroprudential authority come in. You will take the heat out of the market, because it's a ripple effect. Because if I go to my bank and they're only going to lend me $2 million instead of $2.5 million, that affects my affordability. And then it's just taking the less people in that larger bracket into a smaller bracket, and it just condenses everything down. So it's a ripple effect. So we do expect that property prices probably will stabilize. The prices won't go up. It might even fall a little bit in the interim. The other thing that's coming in now, because we've been in lockdown, the supply of property or people willing to sell the properties have been very small. We expect the listings to be quite significant in the next half year. People are going to take opportunities of these higher prices. So I think those two elements will actually probably stabilize the prices. But I don't see the prices falling more than 5%. And this particular macroprudential intervention is nowhere near as significant as it was in 2018 when they were attacking investors. So some stability.
Paul Mirren from Msquared Capital, thanks for joining us.
Thanks, Peter.